Hi, I'm Pattu from freefincal. Today let's talk about focused mutual funds and if they are better choices than index funds. The way they are sold is that the portfolio will be focused. They'll have only 30 stocks, and therefore the possibility of getting higher returns or even beating the index is higher. That's the kind of sales pitch that is associated with these funds. So technically these are funds that are supposed to hold 30 stocks or less. They can have they can be large cap stocks or multi cap stocks or mid cap, small cap, whatever, but the fund manager too should specify, that is the scheme document should specify what is the investment style. So it's only been about 4 years since the fund category has been in inception. So we can't do rolling returns, so we will just do trailing returns and find out how things have fared. In the last year, out of 26 focus funds, 5 funds have outperformed Nifty 50. Only 5 funds. That is in the direct plan. If you are a regular plan investor, only 2 funds have invested. That's where all the commissions have lost. So over 2 years, 13 funds have outperformed out of 23 funds in the direct plan and 9 funds out of 23 in the regular plan. Over the last 3 years, 13 direct plan funds have outperformed the Nifty 50 out of 20, and 9 regular plan funds have done the same. Over the last 4 years, 8 out of 17 direct plan funds have done better, and 7 out of 17 regular plan funds have done better. So you can see that the sample set in 2018 it was only 17 funds, and now it has grown to 26 focus funds. And if you look at the funds that have made the cut, that has outperformed Nifty 50 over the last 1, 2, 3 and 4 years, only 3 funds have qualified. The focus funds from Nippon India, ICICI and HDFC. Please don't make the mistake of selecting these funds. Please remember the past performance disclaimer. They may not do well in future. So if you look at the last 1 year and 4 year durations, less than 50% of funds have outperformed the Nifty 50. Over the last 2 years and 3 years, slightly more than 50% have done better. So you can't say anything concrete at the moment, but it's too early to technically, as an analyst, it's too early to dismiss focus funds or to approve of them. However, but as an investor, you're actually going to put money. I mean, you can't put your own money and experiment. So the logical choice would be to stay away from them because that's just too much of risk with your money. If you gave me a choice only between focus funds and index funds, I will have the best of both worlds and simply choose a Sensex index fund. Then it will be an index fund, and it will also have the focus tag of 30 stocks. So of course Nifty and Sensex returns are not that much different. So that would be the simple logical choice, because again the same problem, today's outperformers may not be tomorrow's outperformers, and only about half or a little bit more than half the category is beating the index based on past performance. We don't know which half your active fund will be in future. Will it be in the performing half or the underperforming half? That's the risk, and you can avoid that risk by simply choosing index funds.